What we're going to cover in the next few minutes is the Dodd-Frank Act, and specifically its effect on seller finance transactions closed on or after January 10th, 2014. There's the legal disclaimer. I'm not going to read it, but we'll pause for a minute so that you may do so. Folks, the information here is intended simply as a guideline and some suggestions. This info is designed to accomplish nothing more than to cause you to be cautious and to provide you with a lot of questions and topics for you to discuss with your real estate attorney. So before we begin, why is seller financing so important? In a capitalistic free enterprise market, supply and demand is the controlling mechanism for deciding who gets what and for making markets flow smoothly. Currently, as many as 80% of adults cannot qualify for a bank loan to buy a house. So even though the supply of houses is very large, for practical purposes, the supply of available houses that people can get is very small because they can't qualify for loans. But the demand, however, only increases with each passing year that people cannot buy houses. The demand for housing is always going to be there and it's always going to rise. The question is, in which way and manner will supply be able to meet that demand? Historically, whenever banks have been unwilling or unable to meet the demand by providing reasonably available financing, seller financing has stepped in to fill the gap. And that is why seller financing is paramount, why it is still a viable tool, and why you will see after viewing this presentation that it is still something that you'll be able to use on a regular basis, especially in today's market when it is so sorely needed. Summary of points to be covered. We're going to go over which types of transactions are exempt from Dodd-Frank, which parts of the Act you must comply with even if the transaction is an exempt one, the 8 factors you must consider and apply against reasonable underwriting guidelines, what is a qualified loan, new rules for foreclosing on seller finance notes, licensed mortgage originators, and penalties for noncompliance. Now, for a healthy dose of perspective, this is not the first time the government has came up with a new program aimed directly at investor business practices to disrupt them. The Garn-St. Germain Depository Institutions Act of 1982 is the act that gave the due on sale clause its teeth. It was very common before this act for an investor to purchase a house with a bank loan, rehab the house, and then when selling the house, simply hand the loan off to the buyer and then receive the investor profit in the way of either down payment money or many times in the case of a second mortgage. The Garn-St. Germain Act did not stop seller financing. We created subject to, and we continue to do business as usual. The removal of accelerated depreciation actually had a massive impact on the housing market that took years to get out, but we still continue to survive and prosper. Folks, Ron LeGrand once said, wealth is created by chaos. The number one thing that the Dodd-Frank Act is going to do is it's going to scare a lot of investors out of the seller financing market needlessly, meaning that those 80% of people that cannot qualify for a loan are going to be even more underserved by the few investors like yourself who have taken the time, effort, energy, and investment to educate yourself on how to still do business even in the midst of a changing legal climate. What type of transactions are exempt from Dodd-Frank? We have paper expert Bob Leonetti to thank for the acronym RICOLA. Rental, income, commercial, land, apartments. None of those types of transactions are covered in any way by Dodd-Frank. The 3 transactions per year are also exempt from Dodd-Frank for most of the provisions, which we will again cover later. But on a side note, you have the National Association of Real Estate Investors to thank for the fact that we get to do 3 exempt transactions per year and not 1 transaction every 3 years as was originally written into the bill. Through the lobbying efforts of the National Association of Real Estate Investors on Capitol Hill, we were actually able to get it changed to an allowable 3 transactions per year exempt versus 1 every 3 year, or in effect a ninefold increase in your ability to do seller financing without all of the onerous regulations that they're imposing on it. Now, exempt is a touchy word because even for your three exempt transactions, if the borrower is going to live in the house, there are still a couple of rules that you are going to have to use and apply from Dodd-Frank. And then three transactions is per person or per entity. That's going to be a question for you or your lawyer, whether that means you can do three transactions per land trust, per LLC, per corporation. At this point, that's completely muddy water. Now, even on your three exempt deals, here are the three things that you still have to comply with as relates to Dodd-Frank. You must consider the borrower's ability to repay. Now, if you consider a vague word, I wholeheartedly agree with you and can only say that if you're uncomfortable with vagueness, you're really not going to enjoy the rest of this presentation because Dodd-Frank abounds with vague terms that are subject to dozens of interpretations. You are no longer able to put a balloon in your deal, but as we'll show you in a subsequent slide, that is really not an issue and it's not important anymore. And number three, the interest rate has to be fixed for a minimum of 5 years. Now we'll cover all three of these in more detail because they also exist in the non-exempt deals. So for non-exempt deals, the 8 factors that you must consider and apply against reasonable underwriting guidelines at minimum: current or reliably expected income or assets, present employment status, total monthly payments on covered transactions, total monthly payments on any simultaneous loans. In other words, if you have sold the house and split the note into a first and a second, which a subsequent slide will show you why it's a good idea to do, the payments together must be considered. The monthly payment for mortgage-related obligations such as taxes, insurance, and maintenance, current debt including alimony and child support, monthly debt-to-income ratio, and credit history. So how do we comply with all these things? All information in the previously shown 8 qualifying criteria should be obtained from a reliable third-party source, according to Dodd-Frank. Apparently, the borrower is not in and of himself a sufficiently reliable source, as we've seen through the failure of stated income loans throughout the years. So you are going to have to order this information, anything from credit reports, financial statements, and bank statements, from an objective third party. You're going to want to keep a copy of each item that you used for verification that they could afford the house in the file. And it would be an extremely good idea if you were to type up a one-page summary of what objective information led you to believe that they could make the payment and put it into the file, so that if in 2, 3, 5, or 10 years you're hauled into court and have to explain why you made the loan to this person, you have a very succinct summary of exactly what it is that made you feel that they should qualify. Now, Dodd-Frank recommends using a 43% debt-to-income ratio as a guideline, so we'll talk a little bit more about what that means. In order to calculate a debt-to-income ratio is very simple. You would first add up all gross or pre-tax household income from all sources. You would then add up all fixed monthly expenses, which you can easily find on their credit report, including debt servicing and related expenses on the loans that you are originating. And then you simply need to divide the answer that you got in number 2, the expenses, by the answer you got in number 1, the income, and you will come up with a decimal number that's equivalent to the debt-to-income ratio. For the example of a $5,000 monthly income, $2,000 fixed payments, including the debt that you are originating, 2,000 divided by 5,000 is 0.4, or a 40% debt-to-income ratio, which according to Dodd-Frank would be fine. What is a qualified loan under Dodd-Frank? A qualified loan may not have a negative amortization, it may not have a balloon, It cannot be amortized over more than 30 years. It cannot have a prepayment penalty in excess of 2% for the first 2 years, 1% for the third year, and it may have no prepayment penalty at all after the third year. Creditors must verify income and assets through independent third-party reports. Creditors only need verify employment status, monthly payments, or simultaneous loans, except as they fit into the debt-to-income ratio, which by all appearances they always would, so you would probably want to go ahead and verify them anyways. Creditor need not verify credit history, but as a practical matter will do so. If it were me, I would put a copy of their credit report in the file as well. Balloons. Why is it important for an investor to put a balloon in a seller finance note? Simply put, if we took two different loans, each with the same monthly payment, interest rate, principal amount, in terms of number of months, both amortized over 30 years, and we put a 5-year balloon into one of them, the one with the 5-year balloon will be worth much more to note buyers if you attempt to sell it due to the time value of money. Money soon is worth more than money later. So why is this no longer a concern? Again, according to real estate paper expert Bob Leonetti, 4 to 5 years ago, note buyers stopped giving preferential status and pricing to loans with balloons in them. Now, why do you suppose this is? The financial calculator still says that it's worth more. It still says you get a higher rate of return. But what's probably happened is that we can look back and look at which type of loans went sour over the last decade and determine that a very, very high percent of them were loans where the borrower could afford to make the payment, was doing so every month, and then after 5 years, 10 years, whenever the balloon hit, the entire loan was due and payable in full. The risk factor did not make up for the reward factor, and note buyers stopped preferring them. And from a practical standpoint, you can accomplish the same effect if you're wanting the buyer to pay off the loan, or if you want to cash out on the note after 5 years, then you need only start having the note adjust upwards in interest rates to increasingly uncomfortable levels after the mandatory fixed 5th year. Now, here are the new regulations for seller-financed adjustable rate mortgage. The rate must be tied to an index. Dodd-Frank recommends the London Interbank Offered Rate, or LIBOR. The maximum interest rate for first mortgage is the index plus 6.5%. The maximum for second is the index plus 8.5%. So in this case, if the debtor had sufficient income to afford it, it would seem to make much more sense to split the mortgage into a first and second so that a portion could be at a higher interest rate if the number still made sense in that manner. Now, the borrower must still be able to afford in the debt-to-income ratio based on the highest payment that the loan may adjust to. So you have to take the highest the loan can get in 5 or 10 years and use the borrower's income today to ensure that they can still qualify it. And we do have caps on the amount that a loan may adjust. The maximum that it can rise is 2% in any 1 year, not to exceed 6% over the entire life of the loan. Here are some differences in foreclosing under seller finance notes under Dodd-Frank. You may not initiate a foreclosure until your borrower is 120 days delinquent. Now, the standard deeds of trust or mortgages that you're using is not going to say that, so your attorney's going to have to come up with corrective language to accommodate the fact that it is a seller financed mortgage with special rules. You may not put a forced arbitration clause in the mortgage. You have the duty to interact with the borrower and offer them some type of alternative to foreclosure, such as a deed in lieu of foreclosure, forbearance, loan modification, or short sale. And while any of those loss mitigation options are in process, you must completely cease foreclosure proceedings. Licensed mortgage originators. This is a new category of people whose sole existence is to help you to create loans that comply with Dodd-Frank and that your buyers can qualify for. The licensing is done at a state level. Now, if you engage in over 3 transactions per year, you automatically become a mortgage originator, but you don't have the license. So then you're on the wrong side of the state's board of insurance commissioners, and it's just a bad deal overall. A licensed mortgage originator's job is, again, to qualify the buyer for the loan and to ensure that you're in compliance with Dodd-Frank. Folks, for a few $100s, you would be absolutely crazy not to use one. You do not want to take the burden on yourself of saying whether or not this person can qualify to afford your house, when for a few $100s, someone who is state licensed is able to help you there. Penalties for non-compliance with Dodd-Frank. Any borrower on a consumer loan secured by real estate has 3 years to bring suit against the lender for failing to consider the borrower's ability to repay. If successful, they are entitled to every nickel that they have paid you in the last 3 years. Everything from late fees, attorney fees, principal, and interest. You have to give it all back. And even scarier, the borrower can bring such an action at any time during the life of the loan and receive the same back for the previous 3 years. So it's not just for the first 3 years. They could actually bring an action in year 20 and, if successful, recover everything that they've paid you in year 19, 18, and 17. States have the ability to add additional regulations to Dodd-Frank, but they are not able to subtract any of the regulations out of them. So they can make it more complicated, but unfortunately not less. So, in summary, the best way to protect yourself is not to prepare your own seller financing docs. Folks, after January 10th, 2014, use an attorney, use a licensed mortgage originator. In fact, your attorney, if he is not able to provide the function of a licensed mortgage originator, is going to insist that you have your borrower qualified by one. Intent is paramount. Have your borrower sign a disclosure of true mutual intent that your attorney is prepared, so that a meeting of the minds is ensured. And it would also be an extremely good idea to have your attorney put a disclaimer on all seller financing documents that are part of your 3 exemptions per year, stating that the loan is not subject to Dodd-Frank, the reasons why it is not subject to Dodd-Frank, and including an outline of Dodd-Frank so that the borrower may initial it and make an informed decision to move forward with the non-qualifying loan, which ultimately will remove the "I didn't understand what I was doing, I didn't know Dodd-Frank gave me other potential options" defense.